What if I told you that a single executive's social media posts wiped out nearly $500 million of investor wealth in a single morning? Not a data breach, not a fraud conviction, not even a bad earnings call, just a CFO who could not keep his mouth shut on the internet. Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the real story behind the numbers. Today, we are going deep on one of the most dramatic meltdowns of 2026. POET Technologies, ticker POET, down 47% in a single session. What comes next? And is there any price target left worth trusting? We will walk through the entire collapse, the governance failure at the center of it, the legal firestorm building, the technical damage, and a tactical trade framework for what comes next. Buckle up. This one is a masterclass in how not to run a public company. Let's start with the gut punch. On April 27, 2026, POET shares did not simply pull back, they imploded. The stock, which had been riding high on AI euphoria, crashed to close at $7.95, touching an intraday low of $7.50. Think about that for a moment. A stock that was trading near $15.50 just days earlier was suddenly cut nearly in half before the lunch bell rang on Wall Street. Now, if this were a large-cap company with billions in annual revenue, you might call it painful, but survivable. But here is the part that should make every retail investor sit up straight. POET Technologies generated exactly $341,202 in revenue for the entire fourth quarter. That is not a misprint. That is less than the annual salary of a mid-level manager at most financial firms. For a company trading at those levels, with that kind of revenue base, the stock price was never really about what the business had done. It was entirely about what investors believed it would do, and when that belief cracked, it cracked violently. This is why understanding the Marvell termination is not just important, it is everything. Now let me take you back through the timeline, because this story did not start on April 27th. It started the week before, and it is a story about hype, hubris, and one executive who seemed to forget that NDAs are legally binding documents. From April 20th through the 24th, POET was one of the hottest names in the market. The company's chief financial officer, Thomas Mika, went on a social media and media blitz, essentially confirming to the world that POET was the light source supplier for Celestial AI, a company that Marvell Technology had just completed an acquisition of. He went further, projecting that 2026 bookings would exceed $5 million. The stock rocketed, retail investors piled in, message boards were on fire, people were calling it the next great AI infrastructure play. Can you imagine the excitement? A tiny, pre-revenue optical components company supplying the AI giants? The narrative was intoxicating, but here is the question you should have been asking in real time. If this deal was so confirmed, why hadn't the company filed an official disclosure? Why was the CFO broadcasting it on social media instead of in an 8K filing? Those are the questions that separate the disciplined investor from the one left holding the bag when the music stops. And stop it did. Because while retail investors were celebrating, the legal team at Marvell Technology was drafting a very different kind of document. On April 27th, Marvell dropped the hammer. They terminated every single outstanding purchase order with POET, and they did not do it quietly. They did it with a formal notice, alleging that the CFO's public disclosures were severe breaches of confidentiality agreements and non-disclosure obligations. Every single order gone in one notice. Now ask yourself, could this really get worse from here? The answer, unfortunately, is yes. And we are going to show you exactly how. Here is what makes this more than just a POET story. The blast radius extended far beyond one ticker symbol. This collapse created what traders call sector contagion. Peers like LightPath Technologies, Applied Optoelectronics, and Credo Technology all saw red on the same session as institutional investors, and algorithmic traders began reassessing the entire optical component space. The logic is brutal but rational. If a company this deep in the AI optics narrative can have a relationship-ending confidentiality failure, who else might be sitting on undisclosed risks? This is the kind of systemic question that does not get answered in a day. It lingers, it suppresses the entire sector, and it is precisely why governance failures at small-cap companies matter not just to their shareholders, but to the broader market ecosystem around them. Let's talk about the valuation problem, because this is where things get truly uncomfortable for anyone trying to defend even the pre-crash price. Before the collapse, POET was trading at a price-to-sales ratio of approximately 2,100 times. 2,100 times. For context, even the most aggressively priced AI software companies trade at maybe 30 or 40 times sales. POET was at 2,100 times. What that number tells you is that the market was not pricing the business. It was pricing a fantasy. A fantasy that required Marvell to stay, required new contracts to materialize, required the technology to scale from laboratory demonstrations into mass production volumes, and required a management team capable of executing all of that without triggering legal disasters. Take any one of those assumptions off the table, let alone all of them, and the math collapses completely. Now layer on top of that a first-quarter earnings miss where the company lost 9 cents per share against analyst estimates of 6 cents per share loss. And you have a company that is burning cash faster than projected, with its marquee revenue relationship terminated, and a speculative valuation that just lost its entire justification. That is not a correction. That is a repricing of reality. The sentiment destruction has been equally severe. Ratings firms like Weiss Ratings and Wall Street Zen moved swiftly, issuing strong sell signals with explicit concerns about structural viability. And if you happen to catch any financial media coverage in the aftermath, even voices like CNBC's Jim Cramer weighed in, characterizing POET as a, and I'm paraphrasing here, science project. The implication being that while the underlying optical interposer technology may be genuinely innovative, the distance between lab demonstration and repeatable, scalable, commercially viable revenue is enormous and littered with obstacles that this management team has now proven it is not well equipped to navigate. The mean analyst price target has fallen to $6.93, and we fully expect further downward revisions as the full financial gap left by the Marvell termination gets quantified in the next earnings cycle. Now let's talk about who is actually holding this stock, because the ownership structure here is critical. Institutional ownership, the sophisticated money managers who typically provide price stability, sits somewhere between roughly 2 and 7% of the total float. That means the overwhelming majority of POET shareholders are retail investors and company insiders. Retail-heavy shareholder bases create conditions for extreme emotion-driven volatility in both directions. When the story is good, retail investors pile in without asking hard questions. When the story breaks, they flee without a floor. And here is the detail that makes this even more painful. Back in January 2026, the company executed a $150 million direct offering. That dilution event significantly watered down existing shareholders just months before this crisis unfolded. If you bought before that offering and held through the crash, you absorbed both the dilution hit and the 47% collapse. That is a brutal combination. And the pain may not be over because the lawyers have arrived. Multiple prominent plaintiff firms, including Rosen Law, Block, and Leviton, and Gibbs Murrah, have initiated federal class action investigations. They are examining a pointed question. Did management issue materially misleading statements to investors? More specifically, did anyone at POET know about the Marvell termination before the stock finished trading at elevated prices? And if so, why was it not disclosed immediately? If investigators find evidence that insiders withheld material negative information, while retail investors were still buying based on the CFO's bullish social media posts, the legal exposure could dwarf the company's current market capitalization. This is governance risk metastasizing into existential risk. Could we see a scenario where the legal costs alone become a company-ending event? That question is now legitimately on the table. Here is another risk that most retail investors are completely unaware of, and it is sitting in the fine print. Activist short sellers and research firms have flagged that POET may qualify for classification as a passive foreign investment company, or PFIC. For American investors, a PFIC designation is a tax nightmare of the highest order. It triggers complex reporting requirements and punitive tax treatment that can erode your returns even in a scenario where the stock eventually recovers. There is a mitigation event on the calendar, a shareholder vote scheduled for June 26th on the question of re-domiciling the company to the United States. If that vote fails, this structural risk remains firmly in place. Mark that date. It matters. On the technical side, the chart is telling a clear story, and it is not a happy one. POET has broken decisively below both its 20-day and 50-day moving averages. Those levels, which previously acted as support, are now overhead resistance, meaning if the stock tries to rally, it will hit selling pressure right where those averages sit. The critical line in the sand right now is the 200-day moving average, sitting at $7.18. A confirmed close below that level removes the last significant technical support and opens the door to what traders call a free fall scenario toward the $6.33 breakdown zone. On the other hand, the relative strength index has plunged to 31.58, which is approaching oversold territory. That does create the mechanical conditions for a short-term bounce, what the market calls a dead cat bounce. But do not confuse a tactical bounce with a fundamental recovery. They are not the same thing. The short interest data adds another layer of complexity. There are currently 12.4 million shares sold short, representing over 8% of the float. Borrow fees were spiking toward 5% just before the collapse, suggesting a squeeze had been building. The options market, however, has turned decisively bearish, with a put-to-call ratio of 1.21. The maximum pain level for May 1st expiry sits at $11, but with the stock trading under $8, the gravitational pull of the crash is far stronger than the options market mechanics that might theoretically push it higher. Traders should watch that short interest closely, because could we see a scenario where a massive short squeeze sends this stock back above $10 inside the next 30 days? Statistically, the chances are slim. But in a retail-heavy, narrative-driven stock with a catalyst like a shareholder vote on the horizon, slim is not zero. For those asking whether POET can rehabilitate its story, the answer is yes, but the bar is high. A genuine recovery requires three things. First, a complete overhaul of internal communications so that no executive ever again broadcasts material, non-public information on social media. Second, officially secured partnerships with rumored counterparties like Foxconn or Luxshare, documented with proper disclosures. And third, that pipeline has to convert to real, audited, booked revenue. Management has referenced a $5 million pipeline with an unnamed partner. Until that converts to confirmed purchase orders on a financial statement, it is a story, not a business. The optical interposer technology is genuinely compelling. The AI infrastructure build-out is a real secular trend. But good technology inside a broken governance structure is not an investment. It is a speculation. For those who want a tactical framework for navigating this volatility, here is what the data suggests. A speculative entry zone sits between $7.15 and $7.25, right at that 200-day moving average. If you enter in that range, your near-term profit target is the resistance band between $8.95 and $9.25. However, and this is non-negotiable, a hard stop loss at $6.80 is mandatory. If the stock breaks its April lows without finding support, the next technical destination is that $6.33 breakdown zone, and there is very little standing between that and a test of the $5 range. This is a high-stakes speculative trade, not a long-term investment thesis. Now, before we wrap this up, Smart Stock, Sam has a responsibility to be clear. Nothing in this video is financial advice. I am not a registered investment advisor. Everything you have heard today is for educational and informational purposes only. Always do your own research and always consult with a qualified financial professional before making any investment decisions. Markets are unpredictable, and past price behavior is never a guarantee of future results. Investing, especially in high-volatility small-cap stocks, carries the very real risk of total loss of capital. Please invest responsibly. So here is the bottom line on POET Technologies. The optical interposer technology is real, it is relevant, and it does have a place in the AI infrastructure story. But the governance surrounding that technology is broken, and broken governance destroys value faster than good technology creates it. The Marvell termination did not just remove a revenue relationship, it removed the credibility premium that was holding the entire valuation together. What we are left with is a company burning cash, facing class action investigations, carrying structural tax risks, and dependent on retail investor sentiment for price support. That is not a recipe for stability. It is a recipe for continued extreme volatility. Smart Stock Sam's final read. This is a watch and wait for disciplined investors and a sell for anyone who cannot afford more executive-level surprises. We will be watching every development closely and will bring you updates as the legal picture, the shareholder vote, and the next earnings report unfold. Now I want to hear from you. Here is the question I want you to answer in the comments below. Do you think POET's management team deserves a second chance to execute? Or has this governance failure permanently destroyed their credibility with institutional investors? Drop your honest take down there. I read every single comment. If this breakdown was valuable to you, hit that like button. It takes 2 seconds and it genuinely helps this channel reach more investors who need this kind of analysis. And if you are not yet subscribed to Smart Stock Sam, this is your sign. We cover exactly this kind of deep dive, data-driven market analysis every single week, and you do not want to miss what is coming next. Finally, if this video saved you from a bad trade or helped you see an opportunity clearly, consider sending a super thanks through YouTube's support feature. Every contribution goes directly into making this research deeper, faster, and more valuable for this entire community. Until next time, stay sharp, stay disciplined, and as always, invest smart.